Brad Williams, Frugal Finance, default risk and interest rates. When banks did much of the lending to companies, it made sense for banks to expend the resources to make their own assessment of default risk. And they still do for most lenders. The arrival of the corporate bond market produced a need for third-party estimation of default risk on behalf of the bondholders. This demand came from the need for economies of scale, since few individual bondholders had the means to do the estimations themselves. In the United States, this led to the expansion of rating agencies like Standard & Poor's and Moody's, which formulated conclusions of the default risk of corporation. Using a mix of private and public information, transformed these conclusions into measures of default risk, a bond rating, and made these ratings public. Investors buying corporate bonds today use the bond rating as a shorthand assessment of default risk. The method of rating a bond begins when a company asks for a rating from the rating agency. This request is typically carried out by a company wanting to issue bonds. While ratings are not a legal prerequisite for bond issues, unlikely that investors in the bond market will be willing to buy bonds issued by a company that is not well known and has shown itself to be unwilling to put itself through the rigor of a bond rating process. It is not surprising, therefore, that the largest number of rated companies are in the United States, which has the most active corporate bond markets, and that there are relatively few rated companies in Europe relative in comparison to the United States, where bank lending remains the norm for all but the largest companies. Bank lending, not lending, but bank lending. Corporate bonds are not bank lending. Bank lending is private. Corporate bonds, public. The rating agencies then gathers information from both publicly available data, such as financial statements and the company itself, and makes a judgment on the rating. If it disagrees with the rating, the company is given the chance to submit additional supporting documentation. This bond rating process is shown schematically for one rating agency, S&P, and here you have the issuer, authorize the requester, request for a rating. S&P assigns a team, analyst research, meetings, analysis, presentation, notification, the rating, yes or no, good or bad, a second evaluation if necessary. The rating assigned by these agencies are letter ratings. A rating of AAA from S&P, A, AA, in other words, capital A, small aa, from Moody's is the highest rating granted to companies deemed as having the lowest default risk. As the default risk increases, the rating decreases towards D for companies in defaults. Here we have a listing of bond ratings. Standard & Poor's, AAA, the highest, D, default. We're going to have AA, the ability to repay is solid and differs from the highest quality only by a trivial amount. A, has strong ability to repay. Borrower is subject to unfavorable results of changes in circumstances and economic conditions. B has adequate ability to repay, but unfavorable economic conditions or circumstances are more likely lead to risk. B, regarded as predominantly CCC speculative, B being the least, C speculative, C the most. AAA judged to be the best. You're going to see this, and it just goes on and on and on. If you look at that information on the general contractors page, you're going to see a lot more details. Investment grade and junk bonds. While ratings can range from AAA, safest, to D, default, a rating at or above BBB by S&P is labeled an investment grade, suggesting the opinion of the rating agency that there is comparatively modest default risk in investing in bonds issued by these companies. Bonds rated below BBB are generally identified as junk bonds or as high yield bonds. While it is a subjective dividing line, it is a critical one for two reasons. First, different bond investment portfolios are constrained from investing in bonds below investment grade. The demand for investment grade bonds tends to be greater and deeper than that for bonds below that grade. Second, Companies that are not rated investment grade have a tougher time when they try to raise new funding, and that they also pay much higher issuance costs when they do. In fact, until the early 80s, companies below investment grade often could not issue new bonds. The view that they are exposed to default risk also creates a lot of other costs, including tighter supply credit and debt covenants. Brad Williams, Frugal Finance. See you soon.